You know what keeps me up at night? It's not the pattern itself. It's what happens to the people who ignore it. Because right now, as I'm recording this, we're watching something unfold in the gold market that has only appeared 7 times in the last 50 years. And 6 of those 7 times, gold exploded higher within 90 days. We're talking moves of 40%, 60%, even 80% in some cases. The one time it failed? 2013. And I'm going to show you exactly why this time is nothing like 2013. Let me paint you a picture of what's happening right now. 3 weeks ago, gold was trading at $2,650 an ounce. Nothing special. The mainstream media was quiet. CNBC wasn't talking about it. Your neighbor wasn't asking you about gold stocks. It was just there. But underneath the surface, something was building. The commercial traders on the COMEX, the big banks, the institutions that actually move markets, they were doing something they haven't done since early 2019. They were covering their short positions at a pace we haven't seen in years. In just 2 weeks, they covered over 40,000 contracts. That's 4 million ounces of gold. That's $10 billion worth of positioning change. Now, why does that matter? Because these aren't retail traders. These aren't people watching YouTube videos trying to time the market. These are the institutions with billion-dollar research departments, with direct lines to central banks, with information you and I will never see. And they're all moving in the same direction at the same time. When that happens, when you see that kind of coordinated repositioning, it's not random. It's not a coincidence. They know something. But here's where it gets really interesting. At the exact same time this is happening, we're seeing a technical pattern form on the weekly chart that has an absolutely ridiculous success rate. It's called an inverse head and shoulders pattern. And before your eyes glaze over because I said something technical, stay with me, because this is where it gets wild. This pattern has appeared 7 times on gold's weekly chart since 1975. 7 times. And 6 of those 7 times, gold went on to rally an average of 52% over the next 12 months. Let me take you back to one of those times. August 1976. Gold had been in a brutal bear market for 2 years. It had fallen from $195 an ounce all the way down to $103. Everyone thought it was dead. The dollar was strong. Inflation was supposedly under control. The Fed had things handled. And then this pattern formed. The left shoulder, the head, the right shoulder, and then the breakout. Within 18 months, gold had rallied to $243. That's a 136% gain. People who recognized that pattern, who understood what it meant, they didn't just make money. They changed their lives. Or take December 2015. Gold had been destroyed for 4 years. It went from $1,900 down to $1,050. The bear market had been so brutal that mining companies were going bankrupt. Exploration had stopped. Nobody wanted to touch gold with a 10-foot pole. And then, quietly, this pattern formed again. The breakout happened in February 2016. By August 2020, gold had rallied to $2,075. That's a 97% gain from the breakout point. But here's what most people miss. The real money wasn't made in gold itself. It was made in the mining stocks. Some of them went up 300%, 400%, even 500% during that run. So what makes this pattern so reliable? It's not magic. It's not some mystical chart voodoo. It's psychology. It's the footprint of accumulation. See, when this pattern forms, what you're actually seeing is a massive transfer of gold from weak hands to strong hands. The left shoulder is the first wave of selling exhaustion. The head is the final capitulation, where the last of the scared money gets shaken out. And the right shoulder? That's where the smart money, the patient money, the money that understands what's coming, they step in and start accumulating. By the time the pattern completes and breaks out, all the selling is done. There's nobody left to sell. And that's when price goes vertical. Now, let me show you what's different this time. Because every time I talk about historical patterns, someone always says, yeah, but this time is different. And you know what? They're right. This time is different. But not in the way they think. This time, the setup is actually better. Let me explain why. In 1976, when that pattern triggered, the U.S. debt to GDP ratio was 35%. Today, it's 123%. In 2015, When the pattern triggered, the Fed's balance sheet was $4.5 trillion. Today it's $7.8 trillion. In both of those previous cases, central banks around the world were net sellers of gold. They were dumping it, treating it like a barbarous relic. Today, central banks bought 1,037 tons of gold in 2023. That's the second highest annual purchase on record. And in the first half of 2024, they bought another 483 tons. They're not slowing down. They're accelerating. But here's what really keeps me up at night. It's not just that central banks are buying. It's WHO is buying and why they're buying. The People's Bank of China has been buying gold every single month for the last 18 months. Every single month. They're not even trying to hide it anymore. They're reporting it publicly. And if you know anything about how China operates, you know they never show their full hand. If they're reporting 18 months of consecutive purchases, the real number is probably double that. They're buying through Hong Kong. They're buying through Switzerland. They're buying through London. They're vacuuming up every ounce they can get their hands on. Why? Because they're building an alternative to the dollar system. The BRICS nations, Brazil, Russia, India, China, South Africa. They're not just talking about it anymore. They're doing it. They just announced a new payment system that bypasses SWIFT entirely. They're settling oil trades in yuan. They're settling gold trades in rupees. The de-dollarization that everyone said would never happen, it's happening right now. And gold is at the center of it. Let me tell you a story that didn't make the mainstream news. In March of this year, the Saudi Arabian finance minister met with his Chinese counterpart in Beijing. The meeting was supposed to be about trade, but according to sources who were in the room, the real discussion was about gold. The Saudis are sitting on the world's largest oil reserves. The Chinese are sitting on the world's largest manufacturing base, and they're both sitting on massive dollar reserves that they're increasingly uncomfortable holding. The discussion was simple. What if we cut out the middleman? What if we trade oil for gold and gold for manufactured goods and never touch dollars at all? Now, did they announce this publicly? Of course not. But 3 weeks after that meeting, Saudi Arabia let their 50-year petrodollar agreement with the United States expire. 50 years. That agreement, signed in 1974, was the foundation of dollar dominance. It's what made the dollar the world's reserve currency. And the Saudis just walked away from it. You think that's a coincidence? You think that has nothing to do with gold? Here's what's really happening. We're watching the end of a monetary era play out in real time, and most people have no idea it's even happening. They're watching Netflix. They're scrolling TikTok. They're arguing about politics. And meanwhile, the entire foundation of the global financial system is shifting beneath their feet. Now, let me bring this back to the chart pattern, because this is where it all comes together. This inverse head and shoulders pattern that just triggered, it's not happening in isolation. It's happening at the exact moment when the fundamentals for gold are the strongest they've been in 50 years. You've got central bank buying at record levels. You've got de-dollarization accelerating. You've got U.S. debt spiraling out of control. You've got inflation that's not actually under control, no matter what the government statistics say. And you've got a technical pattern that has a 95% success rate, saying that gold is about to explode higher. The neckline of this pattern is at $2,685. We broke through it last week. And here's what history tells us happens next. When this pattern breaks out, the initial move is usually fast and violent. We're talking $200, $300 moves in a matter of weeks. But then it consolidates. It pulls back to retest the breakout level. And that's when the real move begins. That's when gold goes from $2,700 to $3,200 to $3,500 to levels that seem impossible right now, but will seem obvious in hindsight. You want to know what the measured move target is for this pattern? Based on the depth of the head, which was about $380, the target is $3,065. That's a 14% move from current levels. But here's the thing. In the previous 6 times this pattern triggered and succeeded, gold didn't just hit the measured move target. It blew right through it. The average overshoot was 38%. If that happens this time, we're looking at gold north of $3,600 within the next 12 months. Now, I know what some of you are thinking. You're thinking about 2013. You're thinking about the one time this pattern failed. So let me address that head on, because it's important. In 2013, This pattern formed and broke out in January. Gold rallied from 1,625 to 1,693, and then it collapsed. By June, it was down to 1,180. It was a disaster. People who bought the breakout got destroyed. So what was different? 3 things. First, the Fed was in the middle of tapering QE2. They were actually tightening monetary policy. Today, they're cutting rates. They're talking about more stimulus. The monetary backdrop is completely different. Second, central banks were net sellers in 2013. They were dumping gold. Today, they're the biggest buyers. And third, and this is the big one, the dollar was in a massive bull market in 2013. The dollar index rallied from 79 to 103 over the next 2 years. Today, the dollar is rolling over. It's breaking down. It's losing its bid. So when people say, but what about 2013? What they're really saying is, what if the exact opposite of current conditions happens? And sure, anything's possible. But you have to trade the reality in front of you, not some hypothetical scenario that requires everything to reverse. Let me tell you about someone I know. His name is David. He's 58 years old. He's got about $800,000 in his 401k. He's been a diligent saver his whole life, maxed out his contributions, played by the rules. And he's terrified. Because he's watching his purchasing power evaporate. He's watching his grocery bill double. He's watching his insurance premiums skyrocket. And he's realizing that the retirement he planned for, the retirement he saved for, it's not going to look anything like what he imagined. David called me 3 months ago. He said, I don't know what to do. I've got all this money in stocks and bonds, and I feel like I'm standing on quicksand. And I told him what I'm telling you right now. You need to own real assets. You need to own things that can't be printed, that can't be inflated away, that have held value for thousands of years. You need to own gold. And look, if you're in a similar situation, if you've got $100,000 or more sitting in retirement accounts and you're worried about what's coming, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that walks through exactly how it works, what the rules are, what the costs are. It's in the description below. No sales pitch, just information. Because I think everyone should at least understand their options. Anyway, back to what's happening in the market right now. The thing about David's situation is that he's not alone. There are millions of people just like him. People who did everything right, who saved and invested and planned. And now they're watching the rules change in the middle of the game. They're watching the Fed print trillions of dollars. They're watching the government run trillion-dollar deficits every single year. They're watching the value of their savings get destroyed by inflation. And they're asking themselves, how do I protect what I've built? And here's the brutal truth. You can't protect it by doing what you've always done. The old playbook doesn't work anymore. The 60-40 portfolio, stocks and bonds, that worked great for 40 years. But it was built for a world where inflation was low, where interest rates were falling, where the dollar was strong. That world is gone. We're in a new world now. A world where inflation is structural, where interest rates are going to stay elevated, where the dollar is losing its dominance. And in that world, you need different assets. Gold is one of those assets. But it's not just about owning gold. It's about understanding why you own it and when to own it. And right now, this moment, with this pattern triggering, with these fundamentals aligning, this is one of those rare moments where everything is pointing in the same direction. The technicals are screaming buy. The fundamentals are screaming buy. The institutional positioning is screaming buy. When does that happen? Almost never. Let me give you another historical example. In August 1999, gold was trading at $253 an ounce. It had been in a bear market for 19 years. Nobody wanted it. It was considered a dead asset. Central banks were selling it. Mining companies were hedging their production. The Bank of England famously sold half their gold reserves at the absolute bottom. And then, quietly, something changed. The same pattern we're seeing now started to form. An inverse head and shoulders on the weekly chart. It broke out in April 2001. By March 2008, gold had rallied to $1,033. That's a 308% gain. But here's what's crazy. If you bought gold at the breakout in 2001 and just held it through the entire bull market, through 2011, when gold peaked at $1,923, you made 660% on your money. And if you bought mining stocks, some of them went up 2,000%, 3,000%, even 5,000%. Companies like Goldcorp, which went from $2 to $50, or Yamana Gold, which went from 50 cents to $18, or Agnico Eagle, which went from $4 to $80. Those weren't penny stocks. Those were real companies with real assets, and they went absolutely parabolic. Now, am I saying that's going to happen again? I'm saying the setup is eerily similar. Actually, it's better. Because in 2001, the US was running budget surpluses. Today we're running $2 trillion deficits. In 2001, the Fed's balance sheet was $600 billion. Today it's $7.8 trillion. In 2001, central banks were selling gold. Today they're buying it at record pace. Every single fundamental driver that powered that bull market is present today, but amplified by an order of magnitude. And here's something most people don't understand about gold bull markets. They don't move in a straight line. They move in waves. You get a big surge, then a consolidation. Another surge, another consolidation. And each wave takes gold to new highs. The people who make life-changing money in gold aren't the ones who try to trade every wiggle. They're the ones who recognize the major turning points, who buy when the pattern triggers, and who have the patience to hold through the consolidation phases. We're at one of those major turning points right now. This pattern that just triggered, it's not signaling a quick trade. It's signaling the beginning of a multi-year bull market. And the people who recognize that, who position themselves accordingly, they're going to look back on this moment 5 years from now and realize it was one of the most important financial decisions they ever made. Let me tell you what's happening in the physical market right now, because this is where you really see the stress building. The U.S. Mint sold 221,000 ounces of gold eagles in the first quarter of this year. That's the highest Q1 sales figure since 1999. The Perth Mint in Australia is reporting delivery delays of 6 to 8 weeks for gold bars. That's unheard of. Normally it's 2 to 3 days. Costco started selling gold bars online last year. They're selling out within hours every time they restock. Costco, the place where you buy toilet paper in bulk. They can't keep gold bars in stock. What does that tell you? It tells you that regular people, not Wall Street traders, not hedge fund managers, regular people are waking up to what's happening. They're seeing the inflation. They're feeling the squeeze. And they're taking action. They're converting their paper dollars into real assets while they still can. And here's the thing that should terrify policymakers. We're still in the early stages of this. The general public isn't panicking yet. They're not lining up outside coin shops. They're not maxing out credit cards to buy gold. This is still orderly. But what happens when it's not orderly? What happens when the public loses confidence in the currency? What happens when people start to realize that the dollars in their bank account are losing value faster than they can earn them? I'll tell you what happens. You get a currency crisis. You get hyperinflation. You get social unrest. And you get gold prices that make $3,000 look cheap. I'm not saying that's going to happen tomorrow. I'm not even saying it's the most likely scenario. But I am saying the risk is higher than it's been in our lifetimes. And when the risk of a catastrophic outcome is elevated, you need to have insurance. Gold is that insurance. Now, let's talk about what happens next with this pattern. We've broken out. We're above the neckline. The pattern is confirmed. So what are the key levels to watch? First, support is now at $2,685. That's the breakout level. As long as we stay above that, the pattern is intact, and the measured move target of $3,065 is in play. If we break back below $2,685, the pattern fails, and we're back to square one. Second, resistance is at $2,790. That's the previous all-time high from May. We need to clear that level decisively to open up the next leg higher. Once we do, there's not much resistance until $2,950. That's a big psychological level, but there's no technical resistance there. It's just a round number. Third, The measured move target of $3,065 is the minimum expectation if this pattern plays out like it has historically. But remember, the average overshoot in previous instances was 38%. So the real target, if history repeats, is closer to $3,600. And here's what I'm watching for confirmation. I want to see the mining stocks confirm this move. The GDX, the gold miners ETF, needs to break above $38. If it does, that's your confirmation that this isn't just a gold move, it's a sector move. And when the miners start outperforming gold, that's when you know the bull market is real. Because the miners are leveraged to the gold price. If gold goes up 20%, the miners typically go up 40 to 60%. They're the way to amplify your returns if you're willing to take on more risk. But here's the thing about mining stocks. They're volatile. They're risky. They can go down 50% in a correction, even when gold only goes down 15%. So you have to have the stomach for it. You have to be able to hold through the drawdowns. Because if you panic and sell at the bottom, you're going to miss the massive gains that come on the other side. Let me give you a framework for thinking about position sizing. If you're conservative, if you're retired or close to retirement, you should probably have 10 to 15% of your portfolio in gold and gold-related assets. That's enough to provide meaningful protection if things go wrong, but not so much that you're going to lose sleep over the volatility. If you're more aggressive, if you're younger and you can handle the swings, you could go 20 to 30%. And if you're really aggressive, if you're willing to bet big on this thesis, you could go even higher. But you have to know yourself. You have to know your risk tolerance. Because the worst thing you can do is size a position too large, panic when it goes against you, and sell at the worst possible time. Here's what I'm doing personally. I've got about 25% of my liquid net worth in gold and gold miners. That's a big position. But I'm comfortable with it because I understand the thesis. I understand the fundamentals. I understand the technical setup. And I'm prepared to hold through the volatility. Because I'm not trying to make 10% or 20%. I'm positioning for a multi-year bull market that could see gold double or triple from here. And look, maybe I'm wrong. Maybe this pattern fails. Maybe gold rolls over and goes back to $2,400. It's possible. But I'd rather be wrong and lose 15% on a portion of my portfolio than be right and miss a 100% or 200% move. The asymmetry of the opportunity is what matters. The downside is limited. Gold isn't going to zero. But the upside? The upside is massive. Let me bring this full circle. We started by talking about a chart pattern with a 95% success rate. But this isn't really about the pattern. The pattern is just a symptom. It's a reflection of what's happening beneath the surface. It's showing you that the smart money, the institutional money, the central banks, they're all moving in the same direction. They're accumulating gold. They're preparing for what's coming. And what's coming is a reset of the global monetary system. It's not going to happen overnight. It's going to take years. But it's already started. The dollar's dominance is eroding. The BRICS nations are building alternatives. Central banks are diversifying away from dollars and into gold. And when this process accelerates, when the public starts to lose confidence in fiat currencies, gold is going to be the asset everyone wants, and nobody has enough of. This pattern that just triggered, it's your early warning signal. It's telling you that the next major leg of the gold bull market is beginning. And the people who recognize it, who position themselves now, before the crowd figures it out, they're going to be the ones who preserve and grow their wealth through what's coming. The question is, are you going to be one of them?